You wake up, check your phone, scroll for a minute, and then rush out the door to work. We are taught a very simple equation from an early age. If you want to be rich, you just need to work harder and put in more hours. But that creates what we call linear income. You are directly trading your time for money, and there are only 24 hours in a day. Because your time has a strict daily limit, relying strictly on a wage mathematically guarantees a ceiling on your income. No matter how strong your work ethic is, you will eventually run out of hours to sell. The traditional advice for getting around this is to take whatever you have left over from your paycheck and stash it away in a bank account. But keeping money static exposes it to inflation. The cost of living rises year over year, meaning the currency sitting in your account buys you less today than it did yesterday. This means a stagnant bank balance doesn't actually offer stability. By doing nothing, your cash loses value over time. Traditional saving acts as a slow financial leak. If you rely on a capped wage and put the remainder into a shrinking savings account, you are mathematically trapped. The wealthiest people in Australia use a different equation entirely. They step out of that trap by shifting from savers to investors, decoupling their income from their time. They use the mechanics of compounding. Here, your money generates its own returns, working around the clock without requiring physical labor from you. Let's look at a baseline. Investing $100 weekly over 5 years shows slow, steady growth. But stretch that past 10 years, and returns generate their own returns, causing wealth to spike. Compared to our earlier linear wage graph, the compounding engine accelerates. This curve is the scalable system that allows you to break past constraints of a 40-hour workweek and build wealth while you sleep. To build that engine, you have to acquire the correct financial vehicles. It requires a strict filter on how you deploy your capital. You have to divide everything into 2 categories. Liabilities are things that actively pull cash out of your pocket, like expensive cars or high-interest debt or constant lifestyle upgrades. Assets, on the other hand, are vehicles that deposit cash back into your pocket. They operate independently, without your daily involvement. Smart investors buy assets. They put their money into stocks, ETFs, digital businesses, and tangible property. Relying on a single paycheck in a volatile economy carries massive risk. These assets allow you to decouple your livelihood from a single employer by building secondary income streams through dividends or rental yields. Financial resilience doesn't come from securing a higher salary. Instead, it comes from owning a diversified portfolio of cash-flowing assets that deeply insulate you from sudden economic shocks. It all comes down to a clear psychological divide. The working class labors for money, while the wealthy engineer systems where money labors for them. When you make this shift, time is no longer your enemy. Instead of being the factor that caps your wage, time becomes the essential fuel compounding needs to operate. Because the mathematics of compounding require years to steepen the curve, delay is the greatest threat to the system. Every year you wait drastically flattens your potential return. Eventually, you will reach a point in the future where you look back on your financial decisions. You will either feel profound regret for starting late or deep relief for taking action. Wealth relies entirely on your time in the market. The absolute best, mathematically optimal moment to deploy this system was yesterday. The second best time is right now.